Okay, folks, welcome back. This teaching is going to specifically deal with how to find explosive price moves before they happen. All right, the points of focus in this module: commitment of traders, weekly range contraction, and daily range contraction. Okay, so we're taking a look at a commitment of traders report in the form of a line graph or net traders position chart, and that is going to be this little graph down here. Okay, this is not something that I've created or made up. This is a long-standing staple in technical analysis. Larry Williams popularized this from his work with the commitment of traders, or CFTC reportable report. And the commercials, this red line, you can see commercial speculators. I'm only interested in tracking this red line. Okay, and by following this on a longer term time frame, it'll help give warning signs when there's a potential impending reversal, which when it's a reversal, they sometimes can be explosive in nature. But the CFTC weekly net traders position is the data that creates this graph. And what we do is we monitor 12-month commercial extremes. That means the highest they've been in the last 12 months or the lowest they've been in the last 12 months. And we look for the levels where they reflect net extremes. In other words, they will qualify support and resistance on a higher time frame chart. Okay, so let's take a closer look on how we can use this information. First, we have to draw in our zero line here. So the zero line delineates anything above the zero line, the traders that would be depicted with their respective colors, like the blue speculators. They're usually, street money. They have no idea what's going on. And the large speculators are the green. Okay, they're going to be diametrically opposed to the commercials. Now, it does not mean that they're wrong. It just means that they are the ones that are trend following in nature. You can see as the market dropped lower on the euro, the green line depicts that the large speculators were selling short. So below this zero line, they are sellers. Above it denotes buying. So we can see the commercials were buying all through this decline. Now, right away, you're probably saying, well, how's this useful? We want to look at trend, and we also want to look at key levels that the commercials support. This low here, they had the largest position of longs on at the time, and the market created a low. And we went sideways and then dropped down one more time. We had an increase of buying by the commercials. And I'll show you what these reference points are here with this horizontal line. And I'll add our first area of buying interest by the commercials. And the second one here. See, they're ramping up this big jump up in the red line. And another one over here where they're above the zero line. And we're at that same level. So they are above the zero line, and we're at that old level where it's bounced before. So this could be a key support level. Now notice that they are giving you insight that you otherwise wouldn't glean. If you look at just simple classic support resistance theories, again, it takes you back to the question, which support, which resistance. So from a higher time frame standpoint, this is one of the things I like to teach because it gives you a context behind support and resistance levels that, in my opinion, are key. Now, with this understanding, okay, we know that they have been bullish all this time, long period of time. For like 2 years, they were buying, building up large positions, and then we had a rally up. Notice that this reaction off here was below these two equal lows. Not surprisingly, this move up has taken us above these two relatively equal highs. And we are potentially in an area where we could come back down a little bit lower. And that takes me to the area of business on the commercials now, because look where they're at. We're below the zero line. So they may be indicating a longer term shift in the direction on the euro. We could see it come down a little bit lower. So This is a warning flag, if you will, to monitor what the euro is most likely going to do, at least from a long-term standpoint. The commercial traders, the folks that are long-term hedgers, they're already hedging in some bearishness on the euro dollar. So I use this information to kind of like build the idea around potential future explosive price moves. Okay, next we're going to talk about the weekly range contraction. All right, as you can see here, when we use the open, high, low, and close bar, okay, this is a graphic depiction. It's very easy to see, at least for me it is, when we're using power 3. If we're bullish, we're going to be looking at the opening price and then drop down, buying anywhere between the opening price or just a little bit above it's still okay, but mainly looking for a move below the opening price. That's what we're looking for, power 3 bullish. And when we're bearish, we're looking for the opening price and then a move up to sell or fade that rally and then ride it lower for a down close. Now, that's assuming that we know there's going to be a large range day or a directional bias that lends well to this technique. Power 3 capitalizes on range expansion, so we have to know the likelihood of this phenomenon happening, otherwise we're going to do it wrong. So now, if the opposite of range expansion is contraction, how can we find that? Well, the candlestick chart helps highlight this. So if we look at a candlestick like this, say this is a typical large range day, okay, which would look like something like this open, high, low, close bar here. It could be very close to that in terms of the body portion between the open and the close. So we have the open down here and the close up here if this is a bullish candle. If this was the body of, say, for instance, a Tuesday, and then say Wednesday we had this type of body, we have a smaller bodied candle, which means that we could see a large range day on Thursday or Friday. It's more or less a precursor, if you will, because smaller bodies precede larger bodies. So if we're always looking for action in the marketplace and it's already moving, you're chasing price. So you want to anticipate when price is going to have an explosive or large range or big move or a series of big moves. And it's going to happen by studying the bodies. If the bodies are getting smaller, okay, if we see that, there's going to be a directional move in magnitude that's larger than it has been in recent days or recent weeks. Again, depicting the top of the body on here and contrasting it with this one here. So that's the difference between what I'm looking for. Okay, so the weekly range contraction, we're going to be looking for candles that begin to compress. Ranges that have smaller bodies are key. That's the ones that we're looking for, and we're wanting to trade when they form. Big ranges come after small ranges form, and we ignore the wicks. We're focusing only on the bodies of the candles. Okay, so let's take a couple examples here. As you can see here at this swing low, we've had large body candle, and then look how small the body gets here. Then we have a turning point. In here, price has been moving up. We went sideways, and now look what happens. The bodies between open and the close, they get very, very small. Disregard the wicks. Okay, try to block that out. Focus only on the open and close relationship. When that gets small, what's about to happen is you're going to see an expansion. And this is when anticipating power 3, like the open here, small down move, buying, holding for the close near the end of the day at the top of the range. Similar scenario here, which we can see again, small bodies form after that large one. Okay, we know there's going to be a large range coming. So we want to be focusing on what? What's the trend? It's been bullish. So we could be looking for open, decline, buy it, look for expansion on the upside. Next, same scenario, open, down, movement, buy it, hold for the close. Okay. Similarly, we can see at this swing high, we have a small little body in here. Again, disregard the wicks. Again, small bodied candle in here, disregarding the wicks, and large moves. After each one of these, we're seeing large moves. And this is a weekly chart. Okay, so there's a lot of pips in there. Another opportunity here, you can barely even see a body in this. Very, very indicative of a large range move. And we see a series of 3 weeks that come by way of bullishness, over 300 and some pips available from that one. Then we have a small range again. So what's going to happen? We're looking for range expansion. Big candle forms, and now at the time of this recording, we have a very small body candle again. So weekly range has been compressing, so we're looking for a large weekly range next. Okay, now obviously, as I said with the weekly range, everything is the same for a daily range contraction. So without repeating myself, I have it here for your notes. But let's take a look at a couple examples from the daily perspective. Okay, we can see up in here, after the swing high, we have a very small body candle. Disregard the wick. We don't care about that. We're looking at the body of the candle. Very small little compression. If we are seeing the range compression and contract smaller and tighter, we know there's going to be a large expansion. So the next move, if it's directionally determined to higher or lower, we can use power 3 concepts in that light. Here we see it's bearish, open, rally, sell the high, hold for the close. So we have several days of down movement. Look at the large ranges. This follows right after that small range body. Next opportunity comes in here. Price trades down at an old low. Price gives a big range down, and then we have a small range day here. Okay, so it's an inside day relative to the body. Okay, this is my insight on inside days. I don't care about the wicks. Okay, most trading teaching circles, authors, gurus, whatever, they would never classify this as an inside day because we have this long wicked portion of the candle that went below the previous day. So that would negate this being called a inside day. But from the standpoint that I'm teaching, range expansion and contraction, this is in fact an inside day. Okay, so that means there's going to be a large range expansion or a series of movement that's directional after this day forms. We see that here, several up close days, okay, and creates a swing high. Range gets small here, so we know that there's going to be another series of movement. We have down close candles. Right in here, we have small ranges relative to what's happened recently, okay? So there's a rule of thumb I use. I want to see what's happened. If it's a daily chart, I want to see what's happened in the last 5 to 7 days. Okay, I look back about 5 to 7 days for range contraction and expansion. So that filter for volatility on a daily chart, you want to look at about 5 days, which is typical trading week. But then I also use 7 days because it may have to look back into the previous week as well. And that gives me this whole criterion here. And we can see that there's a large range day in the last 7 days here. So that means these are relatively small in comparison. So we know there's going to be an expansion due. Large range day, and then we go smaller. Okay, looking back, we have a large range day here. So these are relatively small. So we know what's coming. Large range days, big range day. Okay, down here at an old low, we trade below that low, and now look what happens. We have small ranges. Barely any range here at all. Big expansion on the upside, and then we go into a small range here. Big ranges come, and then right in here, after a swing high, small little body, okay? Again, disregard the wicks. They'll trip you up. That's all. Stop running. On both sides of the marketplace, they're taking all the traders out and go right back into the middle. And then the big move takes place down. Explosive price action on the sell side, reaching for an old low, rejection. And now, at the time of this recording, last Friday, we have a small range body again. So we know there's going to be expansion due coming in the next couple days. So we would look for large range days to form. So as a trader, we want to see movement. And by having a study of when that movement is expected, not just where to buy, where to sell, you have to have an expectation for magnitude and velocity. How much can the move be seen before it happens? Is there going to be excitement? And is it going to be animated, if you will? And what I do is I look for when things are getting quiet. That means the traders are going to get bored with it. And when they're not paying attention to it, it takes off. And then everybody else in the retail world will chase it once it's expanding. I want to be in before the big move happens because I'm most likely going to be in while it's expanding up long or expanding lower and being bearish. I hope you enjoyed this presentation. If you'd like to find more, you can visit my website at theinnercircletrader.com.